Okay, everyone, welcome back to another presentation. A few weeks ago, we asked you whether you'd be interested in learning to swing trade or not, or starting to hear about it. And the general consensus was that you would be. So today we're going to start with just the first toe in the water around that. And that's going to be taking a look at some financial sorcery, also known as technical analysis. It's a very broad topic, but we're just going to take a quick look here. First off, let's start with a disclaimer. This is not financial advice. It is for education and entertainment purposes only. Please don't start trading based off of this 10-minute presentation. It is in itself a huge topic and takes a long time to learn and a lot of effort. With that out the way, let's get started. So what have we looked at so far? We have so far looked at fundamental analysis, peering deep into the soul of companies, trying to figure out what it is, what they do, where they're going to be in the future. We've run the numbers on their annual reports, looking at their revenues, their income, all that good jazz. We've peered deep into the gripping risk factors. This is actually my favorite bit of the week. I don't know about you guys, but I just love reading about intense competition and expansion placing significant strain on management. That's just what I live for. Once we've done that deep dive, we do some mystical calculations that are known only to the gods and come out with the value for our company that we're looking at. And then we wait and we buy it when it's on sale. All of that is pretty straightforward. But does it work for swing trading? The short answer is no. It doesn't hurt. It won't hurt your trading to have a better understanding of the company that you're looking at, but it also won't particularly help. And that's because it's not the right sort of analysis. This fundamental analysis can take many years to play out and prove you right. So for a swing trade that only has maybe a few days to a few months to come your favor, it's not the right tool. So what is it that we need? What is the missing link between what we already know about companies and what we need to know in order to swing trade them? Well, this is what's called technical analysis. And I like to break it down for my own thought process into two separate parts. The first of those is pattern analysis, candlestick pattern analysis. Panos talked a couple weeks ago about candlesticks, what information they represent. Just briefly, they show the open, the close, the high, and the low of a stock within a certain a certain time range. And candlestick analysis, candlestick patterns are used by looking at a sequence of candlesticks to try and predict where the price of the stock is going to go next. There's millions of different patterns. Everyone has their favorite ones or a couple of them. And some people will swear by certain ones and say that they're 100% this works all the time. They're lying. None of this works all the time. It's all about giving you an edge. This is, for me, separate from technical analysis, even though realistically it all comes under the same broad umbrella, but I just use it to think differently. And is in conjunction with the technical analysis I like to think of, where we look at sort of more broad market movements for that equity you're looking at, sort of looking at highs and lows, support, resistance, moving averages, maybe things like the MACD. All of those are terms that maybe are quite new to you, but they are things we're going to look at over the coming weeks. These are all also often drawn on candlestick charts, but it's less about looking at sequences of the candlesticks and more looking at areas that the candlesticks show us and draw attention to. But let's get right into it. Let's look at some examples, and that maybe will make things clearer. Let's start with the bad examples. I don't know about you guys, but I can't see crap from these charts. There's technically candlesticks on here. You can just about see over here some candlesticks, but it very quickly just becomes a mess of lines drawn everywhere. You can't see what the actual chart, stock has done. It's just obscured all the information. Likewise with the other chart, there's just a million different colors, a million different lines, trends everywhere. Someone is evidently here trying to tell themselves a story, but have just obscured all useful information. So if that's what bad technical analysis looks like, what does good technical analysis look like? Well, it's clean and it's simple. Those are the two key things you want to be thinking about when you're doing any sort of technical analysis. Find the few key points about the stock that you're looking at and base your trade off of that. So you can see here there's a few lines drawn on, a few points marked out, and that's it. It's because technical analysis is not supposed to be perfect. It's only supposed to give you an edge. There's no point in going into deeper and deeper analysis. And that's quite contrary to how we use our fundamental analysis. When we're analyzing a company for a long-term investment, the more we know about it, the better, because then we can get a clearer picture of what the company's going to do in the future. Because technical analysis is not perfect and will never give us 100% accuracy, we don't want to use it with that aim. We just want to give ourselves a slight edge. And that will be much better achieved with this sort of clean analysis than what we saw on the previous slide. So let's take a look at some actual indicators. What is our most basic technical analysis indicator? And that will, that question on its own has multiple different answers. But I'm going to show you what's known as support and resistance. So if we look at this chart here, we can see that there's an area, a price area, where the stock has not gone below much, right? So it's touched an area here, it's touched again here, touched here and here and here. And every time it comes into this sort of price range, it moves back upwards. And this indicates to us that there's an area of support where there's lots of people interested in buying the stock at this price, and therefore it supports the price and prevents it from going any lower, hence the name. Now, the same is true at around 32, up here. Every time the price reaches up here, it sells off. Here likewise, here as well, and here too. So this indicates to us that there's a lot of sellers in this area, resisting the price from going any higher. Now, if you're not sure why lots of buyers in an area, lots of sellers in an area can move the price up or down, you should go and check out the video we did on what drives price movements of stocks. Now, there's a lot of different things that can cause these support and resistances to form. It could be an institutional investor, someone with lots of money who wants to buy a lot of a share at a certain price. So it just sits a massive order there and people can't sell through it. Or it can be psychological factors. People see that it has bounced a lot from this area and therefore lots of people want to buy in this area and therefore it doesn't collapse any further. Regardless of the reasoning behind what's causing it, you can use it to make some trades. And I'm going to show you an example of my own trading that worked quite well using these support and resistance lines. So this is a chart showing Jet 2 on the daily chart. So each of these candlesticks represents one day. And you can see over here on the left, my first initial trade I took. You can see it spiked immediately, and that's because I had the sheer dumb luck of buying into an airline company 30 minutes before the vaccine was first announced. So the price rose 33% immediately after I bought it, which was fantastic. But once that had happened, I had to decide what to do. Did I just sell out or did I hold? Well, I decided to hold and see what the stock price did. I was already up so much that it wasn't much risk to me. I could just, sell if it came down any further. What I noticed from following the stock over the coming weeks and months was that every time it reached £12, it would bounce back up. And every time it reached £15, it would sell off. And after watching this for a few times, I decided that this was an area of support at 12, and there was an area of resistance at 15. Now, it's not like exactly 15, it's roughly 15 and roughly 12. So, having decided this, I sold my position when it reached 15, because I thought it's going to come back down. And sure enough, it did. Came all the way back down to 12, where I bought in again. It went back up to 15, excuse me. And I sold again at resistance. It sold off, and here it started to consolidate. And I started to consider, well, it's been showing this resistance to where it sells off immediately all the way down to 12, and this time it hasn't. So maybe it's going to consolidate here and break up and carry on upwards. So I almost took a trade here, but decided to just hold off and see what it did. Sure enough, after enough patience, it came back down to 12, where I bought in again, and I'm looking for it to move back up towards 15. So, is this really sorcery? Absolutely not. Now, that's a bit of a weird thing for me to say after just showing you a trade that's worked well for me. But what you have to remember is that none of this analysis is perfect. It's working at the moment, but at some point, that price is going to move out of that channel, and I could miss out or I could lose money. So trading based on just these sorts of indicators is not enough on itself. You have to have sort of risk management involved. You have to be keeping an eye on the market. There's lots that goes into it. For example, if you had taken a trade here on support, looking to sell up at resistance, well, the stock never reached resistance. Well, there's actually a currency, but regardless, it never reached resistance and in fact came back down to support where it broke down and sold off further. So if you had taken an entry, say here, based on a pretty rigorous support and resistance channel, you could have lost money if you were not aware of how to handle your trade. You also should not go and buy Jet2. The longer an equity or a stock is in a channel like this, the more likely it is to break out when it reaches one of these support or resistance levels and either move to the upside or sell off to the downside, because people won't be there buying forever. Does anyone have any questions about that?
Hi there. Thank you so much for watching our video. I hope you really enjoyed it and I hope you learned something. If you have any questions, please let us know in the comment box, and don't forget to like and subscribe so you can learn more about our channel. Thank you very much and see you next time.